Okay. Again, we're doing futures and options, derivatives. And we'll be doing this till the end of the lectures. Remember that the test is tomorrow. The test will not have anything on derivatives, futures, or options. Okay. Now, let's first consider, backtrack a little. We were doing something on options, but let's backtrack for a second. So let's look at futures revisited. One of the major uses of futures is for hedging. And what hedging really means is for reducing risk. And in our sense, it's reducing price risk. We might say price change risk. And hedging is what a lot of companies do. This is not so much an individual investor, but corporations do a lot of hedging. For example, in Indiana, they have the power industry uses a lot of hedges on natural gas because a lot of our energy is created via natural gas. Other places would have hedging on coal, other type of power industries or utilities. And we have something we call, in hedging, the so-called perfect hedge. The perfect hedge. I say so-called perfect hedge because no hedge is really perfect, but this attempts, it's called perfect because it attempts to eliminate all risk due to price fluctuations. Now, I'll warn you, the text is a little confusing on hedges. We'll try to make it a lot simpler. There are two basic types. Of perfect hedges. The first type is called the long. Of course, it's perfect hedge. And here we have that the asset is currently not held. So futures are purchased. So-called long, it's called a long hedge because this is a long position. To lock in the current and that's not the spot market price, but it's the current futures price. And this can be viewed as simply purchasing the asset early. Simply purchasing the asset early. But in here, in fact, no money changes hands until the asset is delivered. Okay. Now, we also have the short perfect hedge. Well, let's say something about this. So, if you purchase the contract at F0, let's F0 be the price, then even if the price the asset price goes up to FT, you will have had the difference between FT and F0, the amount it went up, times the contract price, times the contract amount, of course, these F0 and FT are unit prices added to your margin account. By marking to market. Okay. So if you're in a long position and the spot price goes up, you have things added to your margin accounts. This is like the wheat edge. This is similar to the wheat hedge in example 10.8 and 10.9. With the text wheat hedge in example 10.8 and 10.9, I should say examples 10.8 and 10.9. I think the 10.8 is on page 280, and this is on page 282. Now, the other type of hedge, the other type of perfect hedge hedge is called the short perfect hedge. And this is similar to what we did, and I think you'll find that when you look at especially you look at the long hedge and look at our explanation of it, it makes a lot more sense than the textbook's explanation of it. Okay, let's look about the short perfect hedge. And here in the short perfect hedge, you do what? You sell futures which of course is the short position. While holding the asset. That asset could be stock, that asset could be like corn in a silo. And this can be viewed as selling the asset early. Okay, so we go, the long perfect hedge is buying the asset early, and the short perfect hedge is selling the asset early. So if you agree to sell at F0, which of course is a unit price, then even if the price goes down, to FT at the time that expiration, you don't lose any money. Dollars because of marking to market, because now you would have had F0 minus FT times the contract amount I'm going to switch to another pen. This is getting a little look at. Would have been added, that's better, added to your margin account. By marking to market. Okay, so marking to market makes these perfect hedges work very, very well. Now, there are other kinds of hedges here that we could consider. And the book goes into these other hedging strategies. This, of course, is with futures. We'll see there are hedging strategies with options, too. Let's talk about a couple of them. There's the minimum variance hedge. And this is covered in section 10.10, page 283. We'll just describe this, and we'll go into detail. Here, you want to minimize the variance in the final basis. And the basis, what does the basis equal? This equals the difference between the spot and future prices. Remember, until the end, we always said theoretically, the spot and futures prices can differ. But then we had convergence. Theoretically, at the end, they should be the same, but they're not always the same. So here we try to minimize the difference between those two guys. Now, the second type of hedging strategy is called so-called optimal hedge. And this is in section 1011, page 285. Okay. Now, in this, the only difference here is that this accounts for the investors or corporations utility function Of course, if we know the utility function, then we also know the investor's risk aversion. Remember, we said that an investor is risk averse if and only if the investor's utility function is strictly concave. That won't be on a test either. Okay, but it's something good to remember. Now, let's go back. Let's jump back to. Let's see if we are going to jump back. Okay. Let's go back to options now. remember the last time we did a whole bunch of diagrams on the value and profit for various option holders and purchasers. Okay. Now, let's look at something called put-call parity. Okay. First, notice that for a call option, remember, a call option gives the purchaser the option of buying the asset. The lower the strike price, K, and we always use this K as a strike price. Almost every book uses that. The higher the option premium. OC. Of course, that makes intuitive sense because if you're purchasing an option that to buy the asset at a very low unit value, then you must pay a high price for that. In fact, for a number of values, it may not there may not even exist an option. Now, for a put option, we have the option, the opposite thing. The higher the K, the lower or the higher the OP. Of course, the put option will give us a chance to sell at a price. So the higher price that we can sell at, the higher the option premium will be. Now, also, both the option for both the call option and the put option premiums are related to the expiration date. The longer the expiration date, the higher these will be for a fixed K. Okay. And more importantly is the fact that they must be related to each other and we'll say this is by our so-called put-call parity. Else, there would exist immediate arbitrage opportunities. Okay. So there must be some relationship between the call and put premiums, the so-called put-call parity. So let's see how we do that here. Okay, so let us do the following. Let us give you some notation. We're going to do let's let capital P equal the value for the put writer. It's a value for the put writer. And capital C, we will say, equals the value for the call holder. Okay. So we have a put writer and a call holder. Let's write that out. These are values. And this is for the put writer. And this is for the call holder. Okay. Now, let's look at what happens here. Let's look at this put-call parity. This is some interesting things. Okay. Now, here's something that's done a lot in financial engineering. It's done in the book too. To derive our put-call relation, we replicate and this idea of replicating things is very common in financial engineering and in finance. Sometimes it's a little confusing, but this won't be too bad. We replicate the value of the underlying asset. Okay. And in order to replicate that, we'll do the following. Specifically, we buy a call in other words, we hold that call and we sell a put that means we write that put and make a loan that will be repaid back at K dollars at expiration. And we'll let that expiration be T. Okay, so we're going to buy a put, buy a call, sell a put, and make a loan that will be repaid at K dollars at expiration T. So let's look at this. And first, we'll look at the formula for this, and then we'll do the diagram. The diagram will make it, I think, a little bit easier to follow. Okay. Then, at any time T in the closed interval from the beginning to expiration, we have the following. We have C minus P plus dk equals S. Okay, now let's see what we mean by that. S, of course, is the price of the asset. This is our, what we call parity formula. Now, where, like we had before, D equals the discount factor from now and remember now is T, is any time T until expiration. Remember, expiration is capital T here. So that is, let's look at the formula for this, that D equals 1 over 1 plus I to the T minus T. Okay. I is our interest, period interest rate. A lot of times we take the period to be a year, but it doesn't have to be, especially when we're talking about these options. There could be a monthly interest rate. And the best way to see this, let's look at this graphically. So it's not so easy to see this, the equation immediately, but it's easier to see graphically. Okay. Let's look at this. Okay. Okay, let's look at what makes up this thing here and see if we can't do it. We have plenty of space on our paper. Maybe I'll use my blue one. No, let me do this. First, let's look at the call. We'll go dollars, and we'll go out to K. This is S. Here's K. So we go along to here. the value to the call holder is 0 up till K, and then it goes up at 45 degrees. So the value of the call holder equals C. Because if the spot price is higher than K, then we'll definitely make money buying it here. And that's if we're holding a call. Okay, now, again, we'll do dollars. And let's go along, let's put this K here. Let's come down here. Let's do S again. This is K. Now, the value to the put writer is the following. We're going to have to come down some more. Here we have to go. Okay. So here's the value to the put writer, P writer equals P here. So in the beginning, the value to the put writer is negative here. Because if we're selling at K and the spot price is below that, then it's negative here. Now, also we have the following. Okay, good. Also, we have the following. So if we do something that we had to make that loan, let's do this in blue. Let's take a loan that we repay at DK. This is always DK. At the end here, then actually that's not exactly right. Let's do this. We have a small problem in the notes. Yes, that's good. So we repay this at K. This is a K here. This is 0. Okay. So what do we have? Let's look at this. If you look at the first two guys, what do you get? You combine these, what do we get? If we look at the put and the call, then we get something that looks like the following. We have dollars here. We have something there. This is 0, and this is, let's say, minus K here. And we have something that looks like the following. This is S. We have the K goes up to here, K. And if you look at the stock price or the asset price, what do we have? For the asset price, we have something like this. S. Okay. Now, what do we do here? Now, all we do to get S, all we do is we add the following. We add K to this. If you add K to this, you end up with a perfect graph of S. When we say after adding K. So all this is just by addition of ordinates. And in fact, these graphs make all our different option combinations easy to follow here. In fact, this is the same as the stock price, right? This is equals the combination, which in fact equals the stock price. Because the stock price starts at 0 and should go up at 45 degrees here. Okay. Now, what else do we want to do today? Okay, good. Now, the next thing we're going to do will be the following. Okay. Next, we will talk about first we'll cover option combinations. And I think if you haven't been watching, you should watch CNBC around 5 o'clock Eastern time when they start. A lot of times they talk about options then and option strategies. And some of the option combinations we're going to talk about are covered calls, protective put, protective puts, talk about the long straddles, and we talk about spreads. And there are two we talk about, butterfly and a bullish spread. Now, the butterfly spread is covered in our text. But we'll go over it here too. Then we have a couple also things called strips and straps. straps, okay. And you have things called collars. Okay, so we have a lot of option combinations, and they help us do a lot of things here. So next we're going to cover option combinations. Then we're going to go into another interesting area called option pricing. Move this up a little bit so we can see this, okay. And when we talk about option pricing, we're going to look at several ways to do it. We're going to look at a binary lattice. This is a discrete approach, and the Black-Scholes equation. Binary lattice is discrete model. The Black-Scholes equation is a continuous model. Now, if you look at the textbook, you'll see there's a lot of theoretical things on the Black-Scholes. Now, we won't do all the theory on the Black-Scholes, but we'll give you a very nice interpretation of the Black-Scholes equation. Interestingly enough, the continuous pricing formula came before the discrete pricing formula. Now, there are a lot of interesting things about the Black-Scholes equation. This is the most cited, their paper is the most cited paper in finance. But in fact, in the beginning, it was rejected 3 times by different journals. So one lesson to be learned is don't worry if you get your paper or your idea rejected in the beginning. If it's a good idea, it will come out. The second thing about this is that if you discover something great, try to stay alive, because Scholes got the Nobel Prize for this, but Fisher-Black had passed away. And if you're deceased, you cannot get the Nobel Prize. So if you do something famous, please try to take care of your health and don't do anything too radical. Okay, we'll talk about those. Let's see if we have time to, let me look, we may have time to do a covered call. Let's see if we can do a covered call before we go. Okay, good. Let's do a covered call. Okay. In a covered call, you hold the asset. That's why we call it covered. And write a call on the asset. So that's what we mean by covered. And it's covered versus a naked call. In a naked call, you don't hold the asset. And there you're just hoping that the asset price won't change against you and that you can just collect the premium. Okay, so let's look at this graphically, what we have. I think this will be the last thing we look at today. Okay, so graphically we have the following. Why don't we say that here? Okay. Graphically is the easy way to look at. Okay, let's look at the stock. We'll go like this. Dollars. Okay. Now, we'll assume that the stock price goes up at a 45-degree angle here. And now let's look at writing a call. Okay, we write the call. We have dollars. Again, we go like this. S. And let's take a K. Let's come down here. And now, when we write the call, if the stock price is below the strike price, then we get the premium. This is premium, okay. And then what happens? It goes down at 45 degrees, and this guy goes down at 45 degrees here. Okay. Now, let's look at the covered call. Now we put these together and we get the covered call. Let's go here. Let's go out here. Okay, let's come down. And the covered call, what do we have? We're still at K here. Now we're going to do an addition of ordinates, and what do we get? The value will be what? This is 0 up until K, but here we start going at 45 degrees. So the value goes up here at 45 degrees. Now what happens is that we have an up and we have a down here. So what happens? We go across. This is our value. And here's the profit. Okay, now, let's look like that. When you look at this covered call, this is for the covered call. Okay. Now, if you just look at this graph, you'll say that, boy, that covered call looks pretty good because no matter what I do, I'm making money. But here is covered call looks like you can't lose money. you cannot lose money, but remember that it assumes that your cost for the asset equals 0, which is not realistic. We'll look at a more realistic example next time. Otherwise, it looks too darn good. I mean, it always has a positive value and a better, well, it always has a non-zero value. But if you look at the profit is always strictly positive. But this is assuming that we can purchase the stock at 0 here. Here we have a 0 to begin with here. Okay, next time we're going to continue on with our option combinations. Then we're going to go on to the interesting area of option pricing. And then pretty soon we're going to start to do our presentations. But for tomorrow, good luck on the test. I think it's will be pretty straightforward, and we're hoping everybody does well. Thank you very much.